Welcome back to Markets Today. I'm your host, Mbithe Mwema. In studio, we are joined by Reginald Kadzutu, who is an economic analyst. Welcome to the show, Reginald.
Thanks, Mbithe.
Initially, we had intended to talk about second quarter GDP numbers as well as other macro figures, but these numbers are not yet out. Perhaps we can just focus on inflation and monetary policy committee and maybe give us your sense. Why are we still waiting for the second quarter GDP and these numbers are not yet out? Do you have a sense of what could be causing the delay?
We are in quarter four.
Yes.
We don't have quarter two GDP numbers. I think the excuse that was given is because of COVID difficulties. I'm thinking COVID did not affect emails from going to Kenya National Bureau of Statistics.
Yes.
Or faxes if they are still that backward. So personally, I think the numbers were not good.
Okay.
But they had to play to. They've been trying to play up the investment community that no, we have recovered. Our quarter two is actually better. I think as a point the president mentioned a figure,
yes,
which was not quarter one figure, and everyone was wondering where did he get that figure from. So for lack of a better word, I hope they are not cooking GDP numbers.
Okay.
It shouldn't take most countries globally by the third week or fourth week after the quarter, you're already getting provisional numbers, which keep on being revised, but at least you have an idea. But we're in October, we're waiting for June numbers. So by the time you give us these numbers in October, what are we supposed to do with them?
Okay, fantastic.
Yeah.
But what could possibly go wrong? When we are looking at GDP, even though we don't have the second quarter numbers, what's the biggest contributor and what could possibly go wrong in those numbers?
If you look at Q1 GDP numbers, the tourism accommodation contracted by 9%. I think that will be worse in quarter two.
Okay.
Because of the hard stop completely on it. Transport decelerated to a growth of I think 5 point something from 6.3 the same quarter last year. We had shut down in quarter two. Airlines had been grounded. We literally had 1,000, 2,000 people arriving through air freight. If you look at consumption of oil in terms of even us importing it and local consumption here also drastically dropped between April and June. And the transport sector is what saved us last year.
Yes.
It drastically grew last year. And even last year our GDP was lower. It grew at a slower pace. And it was saved by the transport sector. So if the transport sector, I don't think it will decelerate. I think it will either be flat or lower. So definitely that is going to hit them on that. Agriculture, yes, will continue propping up GDP.
Okay.
But I don't see agriculture growing by more than 5%.
All right.
In quarter two. So that makes that growth very minimal vis-a-vis the other contractions or decelerations that you find in other sectors. Look at the retail sector, which is also one of the big sectors. I think the third largest sector is definitely going to be hit. Restaurants were closed between the second quarter. Look at construction. If you look at the number of plans approved, the number of value of plans approved dropped from 23B in April to around 6 billion. So construction also suffered a lot in quarter two. So if they give any figure above 1% growth,
yes,
this is as good as taking to the Supreme Court for a rerun.
Okay.
Yeah.
All right, fair enough. So I think I also like that you're bringing in some particular sectors. So the transport sector, which has certainly been hard hit, a bit of recovery as the economy opens up. So when we go back to GDP, then would the agricultural sector, the weakness that's expected from then, just overall all the other sectors, could this actually explain what we have seen earlier today with the government saying that they want to review upwards the price of maize? Could they be trying to get to a point of enhancing agricultural output as a percentage of GDP so that the numbers are not as bad?
I don't think so. It won't work that well for them. I'll give you an example of coffee and tea. So apart from coffee, where the volume produced increased and the price also increased globally, tea is the opposite. Volume increased, prices collapsed.
Yes.
So there's not much growth in the tea sector, which is the largest of anything that we do agriculture. Maize is not even that large in terms of what we get from that sector. So if you look at also horticulture, production went down, prices went up. So if globally things open up and our production has gone lower in good weather,
Okay.
and prices generally now drop because there will be supply from everywhere, then this agricultural sector will not give you any growth next year.
Okay.
So the maize element, it's revise the price of maize, you also revise the price of VAT they collect, so it's a way of just getting taxes. So the more expensive something is, the higher the VAT they collect.
Yes.
And which is said, we're going to talk about inflation, but as they continue to do that, the 4.3% inflation figure is not representative, unfortunately,
Okay.
of what is happening on the ground.
All right.
So it can be very fooling to make policy decisions based on that.
All right. So as an investor or sitting in the investment community in Kenya, should you pay attention to the GDP numbers, or is it just good to know moving on swiftly?
The timing they come out is a good to know, because
Yes.
you can't act on them. You can't act on something that is 6 months old.
Yes.
2019 GDP, we were getting it towards May, and I'm thinking we are halfway through 2020. What is this figure going? I've already made policy decisions based on what I thought GDP was going to be. So it is a good figure just to generally know where output is increasing and growing, because GDP is a measure of output. Unfortunately, it doesn't translate to consumption, because it just checks value added up to a certain point. Our dear monetary policy said 89% of hotels are open. I'm thinking, yeah, that does not mean there are people inside those hotels, so they can open.
Okay.
So it's how you look at it and what type of information you are trying to get from it. So it's a good indicator on general activity, but it should not be translated into what demand will be like.
Okay.
And unfortunately, because our GDP does not translate into growth in income.
Okay.
Yeah.
I mean, so interesting, because when you look at the United States as a country, the latest GDP figures are down 31.4%, yet their equities are, you know, they just keep surging and surging and surging, and the investor sentiment is really looking more at the politics of the day as opposed to what is happening. Is that a read-through for other markets, or can you say that the United States is a developed country, we are a developing country, so there's no read-through? Because that country, GDP is negative, but investments, at least in risky assets, are doing well. For us, I don't think ours goes that negative, but our asset classes are not doing well. Is there any correlation?
I don't think you can ever read through that. If you notice what happened when the US shut down, or most of the developing countries shut down, their central banks went into a frenzy, printing money, so to speak, in quantitative easing. And they flooded money, and in the US they're actually sending checks to people with money. So there was a lot of easy money that came, and when money comes easy, you easily take risks.
Yes.
So that money ended up where? In the stock exchange. So now you had a disconnect between the performance of the stock exchange and the performance of the economy, because it was just demand fueled by an increase in money supply.
Okay.
If you come to Kenya, we've heard of stimulus, this, stimulus, that. That money has never gone anywhere. And if it has gone, part of it has been eaten. We have seen the corruption cases and all. And our version of stimulus does not actually end up with money in people's hands. That will go to the stock market. We are so poor that if I get money, the first thing I think of, how many loaves of bread can I buy before the price goes up?
Yes.
Or let me buy
Or who
50
do I
kg
owe?
of, exactly, or pay off my
your
debt.
debt, yes.
So you'll find our NSE or our equity market might actually be a true reflection of what is on the happening in the economy. As much as sometimes we try and massage our GDP figures, then you find that it's not tantamount to everything that is else happening. So if you look, example, for the US, their GDP figures will come out, and you can tie contracting GDP to increasing unemployment and dropping company profits and all. And when the GDP starts going up, you can actually see non-farm payrolls going up, farm payrolls going up. So it's all connected.
Yes.
Here in Kenya, is you have a GDP figure that continues going up and everything else is going the opposite direction.
Okay, fantastic. So I think we will just park this conversation, wait for the actual numbers to come, and we can dig in. But let's keep looking at the macro factors here. So we have seen inflation numbers come out, as well as the decision by the MPC. What's your read-through of these two key events? So
in inflation, yes, month on month has grown by 4.9%. it's
2%.
4.2%. The key thing to look especially at indicators like inflation is not to look at a 1 month period, is to look for at a year or more than a year. So if you look at when they rebased inflation, Kenya likes rebasing things, when they rebased inflation, so from January last year to now, the CPI was at 100, now it's at 108.
Okay.
That means in terms of purchasing power, the shilling has lost 8% of its local purchasing power. And that's why we have an argument with how can the shilling be gaining power externally but losing power internally.
Okay.
So it has lost 8%. So it means the general basket of goods is 8% more expensive. The question is, if you have not gotten a salary increment of more than 8% or an 8% return on your investment between January last year and now, then you're as good as you'll have just kept your money underneath the mattress. Or your salary now, your disposable income has just shrunk just like that. But then if you go further in and look at the breakdown, which Kenya National Bureau of Statistics are good to give us,
yes,
where you have lower income, middle income, and upper income. So you realize the CPI for the lower income is at 110, yeah, from 100, same starting rebase in January last year. That means for the people in the lower income, and the lower income is now more food related, they're buying basic necessities, those prices have gone up by 10%. Between January last year and now.
Yes.
And we know these guys never get a salary increment anyway. The guys from Jengo never get, the house helps never get a salary increment. But their costs have gone up by 10%. In a period where even we're saying kerosene prices have been coming down and all that stuff, they're still gone up by 10%. Then you go to the upper class. So the middle, the upper class, the middle income actually, their CPI is at around 103. Which is like a 3%, 4%. If we are considered the middle,
yes,
our cost have only gone up by 3%. Then you have the upper class, who their cost has gone up by like 4 or 5. Then if you now take the total, that's when you end up with a 4.2% in CPI. So you realize the people that are suffering the most are the people in the lower income, who are the majority of the people in this country, if not close to 90% of the people. So if you then have policy makers looking at 4.2 and making a decision based on 4.2, then you have 90% of the population suffering.
Okay.
Yeah, they will not make any decision that will actually alleviate the pain or enable people in the lower income to actually be able to save, because the disposable income keeps on being eroded. So when policymakers say inflation is at 4%, that's okay.
It's well anchored.
It's yeah, that statement of well anchored. I'm wondering it's anchored where. And we also need to also understand that decrease or the decelerated increase in CPI. So prices have not dropped. There's no deflation. It's just that CPI is moving at a slower, it's growing at a slower pace. And that deceleration is also accounted by the element of the reduction in VAT and the reduction in a number of taxes that the government put in place, and also general drop in demand. People have lost jobs. So if my tomato is going for 40 shillings and there's no one buying it, it's about to rot, I'm going to sell it for 20 shillings.
Exactly.
So a drop in demand also makes prices just generally cool down a bit. So it's not that there's any policy measure that has been put in place to reduce inflation. It's just market dynamics that have pushed inflation, reduced the rate of increase in terms of prices. But prices are still increasing.
Prices are still increasing,
exactly,
but just not as fast as they were in previous periods.
Yes.
But I like the relation that you have brought in, some of the relationships that we need to focus on when we're thinking about inflation. So you are saying that CPI has moved from point A to point B, yet when we come to talking about the exchange rate of the Kenyan shilling against the US dollar, it's a different conversation. Please elaborate on that.
So there are many theories in coming up with an exchange rate. You have the IMF methods that people use, where you can actually get a basket of currencies from your trading partners divided by GDP. It's a whole formula that they normally use to get that. Then there's the general purchasing power parity, because ideally if something is costing cheaper outside because my shilling cannot buy for me here, then I would rather exchange it to dollars and go buy it from outside.
Exactly.
That what makes sense. It's arbitrage. Opportunity starts operating. So a manufacturer will realize, why am I struggling to manufacture a packet of sugar when I can import that sugar at half the price and still sell it at a normal price here in Kenya. So you'll find there's an element of what we call purchasing power power parity. But truth be said, okay, Kenya is not a currency manipulator,
yes.
So that I don't go on the wrong side of the governor, but they do maintain a range where they want the shilling to remain.
Okay.
And what happened this year is, if you notice, around March, April, the reserves for central bank were down to around 4.5, 4.6 months import cover. They were running out of reserves. And when you start running out, when you perpetually run balance of payment deficits and your reserve starts dwindling, you're getting into what we call a currency crisis. So the only two things that you can do to avert a currency crisis, not even avert, is just kicking the can down the road. Number one, either you devalue your currency, yeah, or you borrow to boost your reserves. And I always tell people, we have been so focused on money that World Bank gave, IMF gave, where did it go, where the PPEs. In my honest opinion, that money had nothing to do with COVID.
It had
that was a government to
results.
avert
Exactly.
currency crisis. Because they had the payment that was due in August. If they had made that payment with 4.5, we wouldn't have been in a currency crisis.
Very true.
So central bank had to borrow. Okay, the government had to borrow in the name of COVID emergency to boost central, to boost the reserves to where they are right now. But that was not enough, and that's why they had to allow the shilling to move from 100 in February to 108.
Okay.
Yeah. That's only a way of averting a currency crisis, because we operate a fixed exchange rate regime.
All right, so we've talked GDP, we've talked inflation, we've talked currency. Let's talk about interest rates, starting with the recent decision by the Monetary Policy Committee that left the central bank rate unchanged at 7%. This was expected, but what should we pay attention to? What is the outlook for the interest rates in the economy, and what was your read-through from the Monetary Policy Committee statement?
For disclaimer at the beginning is that the MPC rate does not affect anything in the market. You cannot set a rate which is higher than interbank rate. Then the question is, why would then I exchange or loan each other money at 7% when we are loaning each other at 3%? So I always feel that CBR was only potent when it was being used to price loans. When you remove the pricing of loans factor on the central bank reserve rate, then you ask, what does the central bank reserve rate target? Because the loans in the economy are nowhere near 7%. Interbank is way lower than 7%. So for standard practice that you'll see globally is a central bank would target interbank rate, because that's what they can actually affect. If they want interbank rate to go to 4% or 5%, they reduce liquidity from the banks. If they want it to come lower, they increase liquidity. So you reduce liquidity by buying off, selling more bonds or doing more repos. If you want to reduce or increase liquidity, you do the opposite.
Okay.
That's where they actually have tools to do. But when you say 7%, then we look at you and thinking, oh, so what are you going to do in the market? Then you're doing nothing. Then you wonder, okay, so what does the 7% for? So what I would take from the monetary policy statement is the shock of the statistics they use to come up with their decision. When you read through the statement, you think, if this is the basis of leaving a tool which is not potent anyway, but if you are the policymakers and this is what you're looking at and making economic decisions or advising the president on what to do, then we're in a deep hole. When a monetary policy committee says hotels are now open, 39% were open in May, now 89%, I'm thinking, are we not looking at the wrong metric? Okay. Yes, they are open, but what is the occupancy? Even after opening flights, we realized only, I think, less than 14,000 people came. Actually, that's even high, compared to 200 and something.
Yes.
Just using the month of August as an example. So I'm thinking, and most of them either were in transit, a few, 1,000 were actually tourists that came in. So I'm thinking, okay, so even if you open 100% of the hotels, there are only 1,000 tourists. So if you divide them equally across the country, each hotel has 1% or even 0.5%.
Yes.
So how does that translate to growth in taxes? How does that translate to increase in employment? How does that translate into income for the people that work there? How does it translate to increased demand of tomatoes, potatoes for their restaurants, more usage of electricity? It doesn't translate to any of that.
Okay.
So I'm thinking we are looking at the wrong metric. They go and say they talk about NPLs. And I'm thinking we should be worried as a central bank.
Non-performing loans. So what is coming through from the banks that people are able to pay?
It's at 13.6%, yes. But another statistic that they mention, and I'm wondering they're actually sleeping well at night, is that 38% of all bank loans were restructured. I'm thinking as a central bank, I should not be sleeping well at night, as when 40% of all loans were restructured. That means they were about to be, if there was no restructuring, all those loans will be non-performing loans. That's true. That's 40% of the bank.
Let's take a pause there. When we come back, let's come and talk about non-performing loans and what is happening in terms of the bank restructure. We are talking about Kenya's macro numbers and what do you need to focus on. And the objective of this conversation is just to get you thinking, how should you plan for the remainder of the year, final quarter, as well as some of the considerations to think about when we start the new year. Our SMS line is 20146. I would like to hear your voice. If nothing else, tell me what your name is, where you're watching us from, ask a question on investments if you may, and I will create time to answer this for you tomorrow. We take a short break. When we come back, we will continue having the discourse on the Kenya macro figures. See you in a few.